Three big pieces of news came out on Friday and on Thursday this week around SoFi stock, and the timing around those news is very interesting. And in this video, we're going to break down the news, what happened, and why it's important going forward. We started off on Thursday with a downgrade from Morgan Stanley, who set a $7 price target on SoFi stock, saying it was time to sell the stock. The Morgan Stanley analyst urged that we should reassess SoFi's valuation and judge it more as a bank, explaining in their note that number one, SoFi has significantly shifted its P&L and balance sheet towards that of a bank. Number two, we are heading towards positive earnings generation, as if a bank is the only company that's positive earnings. Whatever. Number three, that the company is running close to target capital in early 2024, as we are now assuming no loan sales until the second half of 2024. I don't know that that's a fair assumption. If rates get lowered earlier than that, then we could see sales in the first half of 2024, but okay. Analyst continues in a note saying that we believe that SoFi should be valued more as a bank on a price to tangible book value basis. Now, based on this note above, the analyst downgraded the stock to an underweight rating, which is basically a sell, despite bumping up the price target where they had at $6.5 up to $7 per share. This price target approximately represents about a 30% down from where SoFi is currently trading at. Now, the interesting piece is that Morgan Stanley has been slowly increasing their ownership in SoFi ever since 2021, consistently buying the stock every year, most recently being on a May 15th, 2023 filing where they increased their ownership even further. Morgan Stanley owns about 6.48 million shares of SoFi. Now, as we can see on this chart, the institutional ownership from Morgan Stanley has been steadily increasing since 2021, when SoFi was trading in the $20 range all the way to the $5 range and now on the bounce back. And Morgan Stanley has been buying the stock higher than this. They've bought it in the low double digits, $10, $12, $13 range back in the beginning of 2022. So the $7 price target rating is also interesting, considering that SoFi is number one, about to be profitable soon, and number two, that they're quoting price to tangible book value because they've made purchases when SoFi was even further away from profitability and even more overvalued from a tangible book value perspective, right? So I found that personally interesting. But later that day, Anthony Noto was asked about this Morgan Stanley note on a CNBC interview. Anthony Noto laughed at this and broke down the return on equity. And if you read between the lines, he was basically saying that they're cheap, even if you do value them as a bank. And personally watching this and the confidence in his response, I thought spoke volumes about what he thought about the Morgan Stanley note. Here, let's listen.
I want to start off the conversation. We have so much to talk about, but start off the conversation on that Morgan Stanley note saying that SoFi should be valued as a bank, not as a tech company or a fintech. What's your response to that analyst downgrade?
My response would be we're a diversified financial company that delivers our value proposition via technology. And so analysts can value us any way that they would like, if they want to value us like a technology company or as a bank. If you look at us as a bank, we're a bank that's structuring our business over the long term at steady state to have a 30% ROE. Banks that have a 30% ROE trade at 4 to 5 times tangible book. We're trading below that today. So that's my point of view if you want to value us as banks.
Okay.
Now, the next day on Friday, Truist Securities came out to reiterate their buy rating on SoFi and their $11 price target. The Truist team said to, quote, ignore the noise, adding that SoFi should be a structural winner as the banking industry fragments, and that demand deposit accounts are pivoting further to digital platforms. Now, this is a really strong notion here from Truist, who projects that SoFi is going to be delivering better than expected earnings results in the second quarter and for the full year. They continue in their note to say, although macro risks always loom over lending models, in our opinion, we are at a point in the cycle where SoFi-specific growth drivers materially outweigh these concerns. So definitely very bullish news, especially from Truist, who has been one of the firms that has been supporting SoFi with more positive price targets and actually believing in the tech valuation of the company as well. Now, late on Friday, we also received news that Cathie Wood had also added more shares for the Ark Innovation Fund, which purchased another 424,000 shares, or about 0.36% of the total ETF weighting. A few weeks ago, the fund initiated a position into SoFi, buying around 283,000 shares. And we mentioned this in the SoFi Weekly that when Cathie initially started the position, I personally had hesitations around drawing conclusions because this was a very small purchase. It was only like $2.5 million, something like that. But I'm growing more bullish on the idea because Ark is building a position in SoFi for the long term, as opposed to Ark just buying SoFi as a rebalancing play or a hedge against another position. And the reason why is because the second purchase came a few weeks after the first purchase, but it was larger than the first purchase. And it shows that the fund is slowly dollar cost averaging to SoFi. I think their average price is something in the high $8 range. Now, the conclusion in this video is that there's always going to be noise around stocks that double in price over a couple of months and companies that are nearing that profitability mark. But in my opinion, all of this is overwhelmingly positive because it creates more conversation around SoFi and it creates more awareness around the company's ability to execute on their targets. And for the fact that every downgrade we get today, there is another firm ready to upgrade. This is also an overwhelmingly positive sentiment because it's something that we didn't have when the stock was trading at $4. At the $4 range, very few firms were willing to put their reputation on the line to back a company like SoFi and their prospects. But at this price point, it's a little bit of a different story. It becomes a mixed battleground of opinions out there from all of these different analysts. Finally, the timing of this is very interesting because into this week, banks are going to be reporting earnings. All the major banking players are reporting numbers. Bank of America, Charles Schwab, Morgan Stanley, Ally Financial, Goldman Sachs, and many more companies are reporting earnings. And with so many banks reporting on the same week, we can feasibly draw some conclusions around what the macro environment is like with regards to lending and consumer banking as a whole, where we know for a fact that SoFi competes head-to-head with a couple of these different names. This is going to give us further insight as to what we can expect when SoFi reports their Q2 numbers. SoFi is set to report Q2 earnings on July 31st, just a couple of weeks away. And I can guarantee you that between today and July 31st, when the numbers come out, there's going to be further institutions that come out and adjust their price targets. And perhaps there might also be some hit pieces on SoFi stock. And while all of this is happening, there's also going to be some institutions that are adding to their positions slowly and oftentimes behind the scenes. And we know, but ignoring all of that, we know that SoFi has a very solid foundation to lead them into profitability this year. And personally, I am looking to Q2 earnings to be a validation of that trajectory to profitability. So personally, I'm taking a page out of Truist's book, ignoring the noise, staying invested in this company that I believe will massively outperform all analyst expectations, just as they have been doing for the past 2 years. For right now, this is the Fundamentals of Investing podcast. Thank you so much for listening.